So you want to buy a box of pizza. There's a lot of different types of pizza. Pepperoni, cheese, plain, mushroom. But you can't afford to buy all the types of pizza. One literally costs about 65 Ghana cedis. So here's what you do. So you ask the waitress to bring you a box of pizza with all the different pizza slices. So you have a slice of pepperoni pizza, a slice of cheese pizza, and that's what mutual funds is like. Hi guys and welcome back to the channel. My name is Augustine Hagan, and don't mind my pizza analogy, I'm just feeling hungry. But I'm going to put it out there right now. If anyone feels like buying me a box of pizza, just send me a DM. But all jokes aside, each pizza slice represents a company share. So basically, a mutual fund pulls money from a lot of investors and invests it into securities like stocks and bonds. But that begs the question, why should you invest into mutual funds? So first of all, it's because of the diversification. So from the pizza analogy, the box is not only filled with one type of pizza, but all the different types of pizzas. So you're not only invested into one company, but a wide range of companies listed on the Ghana Stock Exchange. 2. The professional management. With mutual funds, they have professional fund managers that do all the research and come up with companies that are to perform extraordinary, or at least they expect those companies to perform extraordinary. And that's a relatively safer option of investing. If one company fails and its share price reduces, the other companies can compensate for that with their performances. If one pizza doesn't taste good, then there's a variety of other pizzas to choose from. 3. Affordability. Instead of buying all the different types of pizza for an extremely high price, you can get all the different pizza varieties for a relatively low price, even as low as what only one pizza might cost. For companies, it's the same. Instead of buying all the different company shares, you can have a well diversified portfolio of all the different company shares for a lower price. Some mutual funds even accept as low as 10 Ghana cedis. 4 is the liquidity. With mutual funds, investors can liquidate or sell off their shares to get their current net asset value, or in simple terms, to redeem their current money amount or their current profits. Compared to individual stocks, you can only liquidate your shares if there's someone ready to buy it from you. And 6, it's easy to track its performance. There are some restrictions I found on mutual funds in Ghana, which I think is pretty interesting, so let's check it out. 1. Mutual funds in Ghana are not permitted to invest in commodities, futures or options. Commodities includes gold or silver, and futures is a contract with a company that each share will go down or up. 2. Mutual funds in Ghana are not permitted to invest more than 10% of their net asset value in real estate. 3. Mutual funds in Ghana are not permitted to invest more than 25% of their net asset value in securities of only one company. They cannot invest more than 10% of their net asset value in other collective investment schemes. Cannot invest more than 15% of their net asset value in a company whose shares are not listed on a registered exchange. Mutual funds in Ghana are not permitted to gain a controlling stake in any company. Mutual funds in Ghana are not permitted to short security. That means they cannot place a bet that a company's share will go down to make a profit. Mutual funds in Ghana are not permitted to invest in any securities of a company in which the managers of the fund own more than 5% interest. So this is very interesting to know, but there are different types of mutual funds in Ghana, and knowing this information is going to help you decide which one is best for you. Equity funds. These mutual funds invest mainly in securities or shares. They are normally long-term funds that focus mainly on growth of investments. Most equity funds are divided up between 70% in stocks and 30% in bonds, a high risk, high reward. Examples of equity funds in Ghana include DataBank APAC Investment, HTC Equity Trust, and Omega Equity Fund. Money Market Fund. They invest in low risk, short-term securities such as treasury bills, which matures within 1 year. These funds are concerned primarily with protecting capitals of investors rather than seeking growth of investments. Examples include DataBank Money Market Fund, EDC Money Market Unit, Galaxy Money Market Fund, Bond or Fixed Income Fund. Like its name, it invests in long-term fixed income securities such as bonds, notes, corporate debts, fixed deposits, debentures, and longer-term government securities. It may also include some money market instruments like treasury bills, but do not include stocks. Note, if you don't understand any of the terms, just do a quick Google search and you will find the answers. Examples include All Time Bond Fund Limited, Omega Income Fund Limited, and Stanbic Income Fund Trusts, Real Estate Investment Trusts. These exceptional funds focus solely on real estate investments. Examples are HFC Real Estate Investment Trusts. Balanced Fund. As the name suggests, these funds combines all the strategies of different types of funds to try to achieve both growth and short-term protection of capital. Examples include DataBank Balanced Fund, Anidaso Mutual Fund, and DataBank Educational Investment Fund Limited. Ethical funds. These types of funds deliberately exclude certain industries like fossil fuel and tobacco, which they think should not be funded, even if they stand a chance to gain by investing in them because of their principles. So if you as an individual prefer not to support such industries and your values align with that of the ethical fund, you can invest with them. Examples include DataBank Ark Fund Limited. Disclaimer: the example I made of the various mutual funds are just a few of countless many in Ghana. They are in no way better than the others just because I didn't list them. So if you are interested in investing in any of them, please do your own research beforehand. Things you should consider before investing in any of the brokerage firms for the mutual funds include licensing, investment objective, risk tolerance, fund management, performance, and charges. Now I'm not going to sit here and pretend it's all good with mutual funds. Like anything else, there's a downside. So these are the disadvantages of mutual funds. 1. Fees. Being it management fees or fees on deposit or withdrawal, mutual funds can either charge you front-end loads, that is, they charge a percentage, usually 1% of every deposit you make, or a back-end load. Usually they charge you anywhere from 0.5% to 3% when you make a withdrawal. But they are not allowed to charge both. Either they charge on withdrawals and nothing on deposited funds, or they charge on deposited funds and nothing on withdrawals. Charges for withdrawal funds decreases the longer you keep your investment with the mutual fund, and after 3 years there's no charge on investment withdrawal. Apart from this, the fund also charge anywhere from 1% to 2.5% as annual management fee. The maximum they can charge for annual management fee is 2.5%. Anything above that amount, that 2.5%, is illegal according to law. Lack of fixed return. There is not a guarantee of fixed return. The return you make is based on what the mutual funds have invested into. If the companies they are invested into increase in value, then you make money, you make a fixed return. But if the companies they invest into do not perform, then you might also lose your money. 3. Cash draw. Since investors of mutual funds can liquidate all of their shares or sell off any of their shares at any time, mutual funds owners or the brokerage of mutual funds need to have a huge sum of cash lying around to pay these investors when they liquidate their shares. This is cash that could have otherwise been invested to make more returns for investors. So with mutual funds, the returns that you make will always be less than what you could have made if that cash was also invested. Now, I should have mentioned this earlier, but there are 3 ways to make money from mutual funds in Ghana. 1. Through dividends made from companies mutual funds are invested in. 2. When investments of mutual funds appreciates or grows in value and the fund manager sells off some of the shares, the fund makes money through capital gains. And 3. When investors of mutual funds liquidate their shares, they make money through current net assets value. So that's the end of this video. Mutual funds really are a simple and great way for beginner investors to get into the market. So if you have some money around but are not willing to start investing, then you can just test the waters by putting in some of the money into mutual funds to see how it is. DataBank is a great brokerage to try, but there are various alternatives. If you own a mutual fund or plan on buying or investing into a mutual fund, please comment it down below. It might help someone. And if there's anything you think I left in this video, comment it down below too. I would appreciate it if you could smash the like button, share this video, and subscribe to the channel for more awesome content. Thank you so much for watching. Have a wonderful rest of your week. Peace. I'm feeling hungry. Let me go and get some pizza.